What's going on, guys? Welcome back to another video. In this video, I've got another very important AMC update to bring all of you this afternoon. So what we're going to be covering in this video is one, why is AMC being attacked today? We saw some unbelievable pieces of news come out yesterday during AMC's earnings call. We saw the Fudsters at CNBC really try to come out and discredit Adam Aron and all of the points that he was discussing in his interview this morning. And Adam Aron did an unbelievable job countering those points with the cold, hard facts of the fundamental situation that AMC is currently in right now. Now, we're going to go over a couple of those points, but I do have some thoughts on exactly why we are seeing the price action that we are seeing today. Now, in addition to this, we have been talking about this major market event coming in the near future for a while on this channel. Now, there's even more institutions that have come out and basically backed this theory. It is Bank of America, and in the past, we've kind of speculated that they were kind of hopping on this bandwagon due to their new shelf offering, but we have just received some confirmation that Bank of America is looking at a possible 10 to 11% correction by the end of this year. So before we get into all of that information, if you enjoyed the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you want to see more videos like this, make sure you hit that subscribe button. So when we're looking at AMC today, we started the trading day in that $37 range. At the current time that I'm recording, we are down about 5%, trading at $32 per share. Now, yesterday, we all kind of figured out that the short thesis against AMC was essentially useless. It does not hold any weight with where the company is at the current time and where they are projecting to go in the future. Some of the things that we need to take a look at is Adam Aron said liquidity is at a 100-year high. They have $2 billion of cash liquidity in the bank. Now, the other argument was, well, they have a lot of debt. Adam Aron had a really interesting comment about this. They smartly laddered the debt, no debt maturities at all until 2023, and most of them do not come before 2026. They have a very, very solid capital allocation structure, and we have all these other good things coming out as well. They have about 12 new build theaters worldwide, 3 so far in 2021 in the United States. We have concerts, movies, esports, sporting events, pro and collegiate sports, gaming, and a potential GameStop partnership in the works. They are also going to be accepting Bitcoin by the end of the year. Apple Pay and Google Pay will also be accepted. Costs are rising due to inflation, but they are seeing little resistance to the price increases that they have already put in. And the big bombshell, Warner Brothers signed a deal with AMC that they are going to exclusively put their movies in theaters 45 days before any home release, which means AMC is going to be able to compete with streaming in a larger way than they already are right now. So what we are seeing today, in my opinion, is one of those last-ditch efforts in order to shake out retail investors. There is nothing that suggests that the short thesis right now for AMC is strong at all. They are on thin ice. They are continuously kicking the can down the road. And in my opinion, it is only a matter of time before we see this potential short squeeze situation, or the potential mother of all short squeeze situation, really start to take off. Now, when we come over to Ortex, this is where I really think things get really interesting. So the utilization did drop today. We were projecting a little bit of a drop in the utilization towards the beginning of this week, but with the amount of shorting that is going on with AMC at the current time, I am hopeful that the utilization will get above 95 by the end of this week. And if you guys have seen any of my videos over the last couple of weeks, you guys know that the utilization is an incredibly important factor. If the utilization can get back up to that 99 to 100% range, it leads the way for those forced share recalls that played a role in the June run-up. So that is going to be something that we need to take a look at. But right now, today, we are seeing a short interest change of minus 0.78%, and the current short interest as a percentage of the free float is 15.72%, as reported by Ortex as basically the baseline numbers, the bare minimum. So 15.72% is still incredibly high in terms of short interest. Now, going back and thinking about this forced share recall situation, what we have to remember is that lenders can recall their securities whenever they want, for whatever reason they want, and they do not have to provide an explanation. This means that it is not AMC, remember, that is going to be performing these forced share recalls, but is the lenders of the different securities. Now, the big lenders are the large prime brokers or any other institution that has a large position in any given security and chooses to make interest on that position by loaning out some shares. Those institutions are also completely complicit in the overshorting of these given securities. So it is up to them, and it is in their ability to basically fix this situation if they see fit. So that is going to be something that we need to keep a lookout for over the next couple of months. It is not just the hedge funds that have over leveraged on these given securities. It is also the fault of the prime brokers and the large banking institutions, which is something I don't think a lot of people fully grasp. Now, let's get into this forced liquidation and big market correction situation. An additional red flag is the S&P 500 has had positive returns for 6 straight months. As shown in the 10-year monthly chart below, such streaks are a rarity, and when they do occur, they are usually met by a month or more of negative returns. So what this article actually refers to in bulk is the 200-day moving average. So coming down a little bit further, we can see that the 200-day moving average, as denoted by the chart above, is a technical indicator used to analyze long-term trends. The line represents the average closing price over the last 200 days. Each day, the average changes as the latest data point is added and the first are removed, creating a new average price. Now, when we come down a little bit further, we can see that we can visualize the reversion in the chart below of the S&P 500 index versus its 200 DMA. With the index currently more than 11% above its 200 DMA, such should be a short-term warning to investors. Looking back historically, whenever deviations exceeded 10% above the 200 DMA, a correction generally ensues. So this is falling in line with a lot of what we have seen from a lot of other banking institutions, which we will go over in a minute, but we also have Bank of America making some comments about this as well. So Bank of America suggests that the S&P 500 is more likely to test its 200-day moving average in the second half of 2021. History reveals that it is difficult for the S&P 500 to stay above its 200-day moving average for an entire calendar year. So we have seen Goldman Sachs liquidate about 25% of all of their equity positions. Morgan Stanley suggesting a 10% downturn in the markets over the next quarter, and we have Credit Suisse repositioning themselves into gold. So there is a trend here, and we are heading towards a very interesting situation. The thing I want to make sure you guys all understand, though, is that nobody actually knows when this major market event situation could potentially play out. There are a lot of projections right now that Q4 could be the time, but again, nobody really knows. What I'm trying to do here is educate you guys and give you some of the more in-depth market analysis that shows exactly where big money is going. We have seen Goldman Sachs sell and then upgrade their rating on the S&P 500. What this suggests is that they are still liquidating positions, but trying to keep the market propped up in order to have retail and other institutions potentially keep supplying the bids for their sales. Now, going back to what Bank of America is saying here, Bank of America is, one, getting very defensive in their positions. We have seen some things come out of Bank of America that suggest that, one, they are liquidating their positions and loading up their war chest. What we need to take a look at here is this situation right here with Bank of America. So Bank of America files a shelf offering of $123 billion in debt and equity securities over time. What we need to keep a lookout for is if Bank of America starts to offer a lot of these securities over the next month and a half. If they do, that suggests that they think that they are, one, going to need a lot more cash on hand, specifically in their equity or bond department, in order to maintain these over leveraged positions, in order to maintain a significant market correction. Now, the reason why a lot of people, including myself, have been talking about this major market correction is because of this chart right here. When we pull up this chart, this is the FINRA margin debt and the S&P 500 real values adjusted to present day dollars. The margin debt is approaching $900 billion at the current time. And if anything starts to happen in the market, we are going to see a lot of these fire sales, forced liquidations, and the market start to sell off. Now, we've gone over how this affects AMC in the past, and either way, if AMC squeezes before or if the market sells off before, in my opinion, it is going to result in a short squeeze. So there are a couple of reasons for this, and I can go over a couple of them right now. If the market does sell off first, I do believe that AMC would go with it. There have been some data points that come out that say AMC has a negative beta, in which you would expect to see AMC go up when the market sells off. But with the manipulation that we are seeing from AMC right now, or not from AMC, but being done to AMC, honestly, if the market sells off, AMC is most likely going to take a significant hit. But here is the silver lining to that. When the shorts really start to double down and try to push AMC even lower in the times of a market correction, they're just adding to the overall number of shares that they're going to have to cover eventually. And a lot of these shorts in position that these institutions have are based on algorithms. So at some point when they can get the price low enough, they are going to have their algos switch to buy, and that could be when the shorts get covered. So when we see the price of AMC drop on any given day, especially what we are seeing today, in my opinion, nothing has changed. Again, we have seen so much good fundamental news come out about this company over the last 24 hours. The price action that we are seeing is not reflecting that good fundamental news. In my mind, the shorts have not covered. We have not seen anything bad come out from the company, and we are still in the same position that we were a week ago, 6 months ago, and even a year ago. So that is going to conclude this update on AMC. If you enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you want to see more videos like this, make sure you hit that subscribe button. So I hope you guys are having a great day, and I'll see you guys in the next video.